What affects my credit score? The three main credit bureaus are Equifax, Experian, and TransUnion. They collect information about your financial history to produce a credit score. This score is based on the information in your credit report, which includes things like how repaid loans, how much debt you have at any given time, and how often you pay your bills on time. Most people don't know what affects their credit score. The good news for them is that there are ways to improve it in order to get better rates in the future or just get approved for a loan. The main difference between these bureaus is how they calculate the likelihood that an individual will pay back their debts on time. One way is by looking at the number of accounts an individual has opened in a short amount of time. This also includes how many accounts are currently delinquent or have been closed within the past 24 months. Another way is by looking at missed payments which are reported to them by creditors, or balances left unpaid after loans have been repaid. The third way is through consumer reports, which come from retailers who receive payments from checks or bank account withdrawals made with their credit cards. Your credit score is based on your history of borrowing money. It's made up of information about the different types of credit you have, how much you owe, and how you handle paying back your debts. Credit scores are used to measure the risk of lending money to people based on their past payment history. Your payment history can affect your credit score. This is because the information in your credit report shows creditors that you are a reliable person who pays their bills on time. Credit bureaus use this information to calculate the amount of risk they are willing to take on you. If you have a high risk score, it could make borrowing money more expensive for you or even impossible. It is important to know the amounts owed as it affects credit scores. You may end up owing more than you can afford if you don't keep tabs on your debts and account balances. There are many ways you can do this, like checking your credit report and credit score, or by using a budgeting app like Mint. We should pay attention to our debts and the amount we owe so that we don't have to spend money from our paycheck on these bills instead of having it for food or other necessities. Building a strong credit score might not happen overnight. A person with a short credit history may need to take some extra steps to show lenders that they are responsible and reliable. The key is to make every one of your accounts count and avoid closing any accounts as soon as you've opened them. It also helps if you manage your accounts responsibly and pay off the balance every month to avoid interest charges. Consumer Financial Protection Bureau. The length of your credit history can impact your credit score. If you have a short credit history, it may not be considered as long as someone who has had accounts open for many years. Your account age is important to the length of your credit history. A good rule of thumb is to keep them open until they are paid off to avoid any negative impact on your credit score. Some companies only use the length of your credit history to determine if they will offer you a loan. They also factor in how old your credit line is. The older it is, the less likely you are to get approved for a loan. If you have credit left open, it may affect your future applications for new credit accounts. If you want to be eligible for loans with lower interest rates, then it's important to close any accounts that have been open for the longest amount of time. The most common credit mix is a 50-50 split between revolving debt and installment debt, with some people carrying more or less debt in one category or the other. Some examples of revolving debt include bank cards, revolving lines of credit, etc. Examples of installment debt include mortgages, car loans, student loans, etc. The higher your credit score, the easier it should be for you to get loans at a low interest rate. However, it should be noted that there are many other factors that lenders use when determining what they will offer you in terms of loans. A large factor in most cases is your employment status. Many people are unaware of the impact that taking out a loan has on their credit score. A common misconception is that taking out a loan will always improve your credit score. The truth of the matter is that it depends on the type of loan and the amount you apply for. If you take out a loan to pay off existing debt or for something that will help improve your credit score, then it can have a positive impact. However, if you take out a high-interest personal loan to buy something unnecessary, then your credit score will be negatively impacted. The three major credit bureaus, Experian, Equifax, and TransUnion, each utilize a different credit scoring system to calculate your credit score. For example, Experian uses the Experian Fair Isaac Corporation or FICO scoring system, which is a type of non-traditional credit score. Experian also uses other proprietary algorithms to calculate their scores. The main difference between the three major credit bureaus is that each bureau has its own proprietary scoring system, which may or may not be based on the traditional FICO score system. This makes it difficult for one to know how their individual scores will be calculated by all three agencies. Thanks for watching Budget Wrench, the channel that helps you upgrade your budget and puts that extra cash back in your pocket. Stay tuned until the end of this video where you will find information on how to adjust your current budget and put hundreds of dollars back in your pocket.